Introduction. What investments do you see in your future? If you're like most people, you probably look at the state of the world and wonder what will happen to your steady job in the future. After all, with the onset of COVID-19, there's no guarantee that you'll have the same position you've had for years. But have you considered investing in yourself? Unfortunately, so few people today know how to invest in their futures, even if they have some cash on hand. The world of investments is tricky and often comes with a sea of ups and downs that inevitably affects how quickly you can earn money. If you invest in the wrong ventures, you could see a devastating loss. The old adage, you have to spend money to make money, is truer today than it has ever been in the past. Though you don't need to throw a big chunk of money at every investment strategy, investing some money in yourself and the improvement of your future is key to developing a strategy that will provide income for years to come. Who knows, you can end up loving your new investments so much that they become a full-time gig. Spend It on Yourself, an intelligent program for beginner investing, managing your money toward financial freedom using time and energy to balance a richer life, was written with the first-time investor in mind. This book is packed with the knowledge to further your education in 5 forms of investments: real estate, 401k and retirement, small business, stocks and trading, and physical investments. You're sure to find your niche in one of these investment plans, and you'll be well on your way to developing a plan to maximize your earning power. By the end of this book, you'll have a better understanding of which investments are more suited to you and which you may want to try at a future date. Whatever the circumstances, there is always an opportunity to improve. Follow these examples, and you'll be making a significant amount of money in no time. Chapter 1. Investment in Real Estate. Getting into debt is scary. Even though the common adage, "you've got to spend money to get money," is the battle cry of the rich, making that investment can put a mental strain on you. It may seem like getting into debt is the last way to ultimately improve your assets, but nothing could be further from the truth. In fact, investment in real estate is the first step to building an empire of equity for your future. How investors make money in real estate. Real estate is one of the most common forms of investment on the market for both newbies and seasoned veterans. Renting, leasing, and flipping properties are common investment techniques that are used around the world. If you know what you're doing, real estate can pay off big time. Buying a home is one of the biggest decisions of your life. Homes can range from less than $50,000 overall to well over $1 million. However, if you're looking to turn a profit in real estate, you've got to know which homes have the most potential. Investors make money by reading the market and choosing investments that will give them a positive cash flow. When all is said and done, real estate will cost more than you think. Appraisal fees, insurance, title reports, property inspections, and utilities add up over time. With the addition of a team of real estate agents, real estate attorneys, accountants, home inspectors, and title companies required to get the best home deals, you'll probably spend far more than you initially thought. When it comes down to it, you'll not likely make a profit on your purchases for at least a few months, depending on how quickly you can flip them. However, once you get the hang of how to get the most out of your investments, you can start to make some serious income. A house mortgage should be the only type of debt you assume when you invest in real estate. While it's true that you could go into debt paying for fees and renovations to the property, if you stick with the mortgage, you are ultimately better off. Sometimes, lenders will offer compensation to help you fix up homes, which can be added to your mortgage payment. The debt used to make these renovations is a necessary evil. You may have to put in several $1,000s for each renovation to make sure everything is up to code. On top of the mortgage payment, it can feel massively overwhelming. However, if you keep your eyes fixed on the final profit, you can be successful. Renting, flipping, and reselling are the three cornerstones to turning your debt into profit, and the key to each of these methods lies in renovation. Fixing up a home before renting will increase the monthly cost. Renovations when flipping a home can theoretically earn you tens of thousands of dollars or more. Finally, if you're lucky enough to get a cheap home, reselling after minor adjustments can also drastically increase its market value. Getting a mortgage is more accessible today than it has ever been in the past. Interest rates on homes have drastically reduced since the 1980s. At one point, obtaining a mortgage meant agreeing to a nearly 20% interest rate, Abdul Samad 2017. However, recently, lenders have reduced the rate to only 4% to 6%, and in reduced housing markets, that number could reduce even further. Of course, the best way to get the most out of your mortgage is to avoid as much accrued interest as possible by increasing your monthly payments. Paying off your mortgage quickly means your debt-to-income ratio will improve. The debt-to-income ratio is the calculation of your monthly debt payments compared to your income. For example, if you pay $1,000 in monthly mortgage payments and another $1,000 in other expenses, your monthly debt payments equal $2,000. If you earn a gross monthly income of $5,000, your debt-to-income ratio is 40%. Once you concentrate your efforts to lower your debt-to-income ratio, you'll get more loan approvals and ultimately lower your interest rate for further purchases. Investors that use this technique are better able to determine how much real estate they can have on their plates at one time. Determining your debt-to-income ratio also makes you a stronger candidate for venture capitalists looking to invest in your company. Why invest in real estate? It's true that the best of the best often makes the most money when investing in real estate, but they also must prepare for harder times. Housing markets fall, and people become disinterested in the property. You've likely backed out of a deal yourself in the past due to unforeseen circumstances. You may have also experienced a personal tragedy that has prevented you from purchasing the home you wanted. So why would you take such a risk? Real estate is still on the top of the list for millionaire investments. Andrew Carnegie, one of the wealthiest men in the world, contributed much of his success to real estate. In fact, one of his most famous statements explains that 90% of all millionaires become so through owning real estate. The key to making good money is knowing how to work the market and interact with people in a way that will make them remember you. Income. The most common reason for individuals to get involved with real estate is the money that comes with it. If you're interested in owning rentals, you have a steady stream of income. If you venture out to the riskier regions of flipping and resale, you're likely to come out with a much greater reward. Investors see real estate with the potential for success. That means that real estate moguls are more interested in the long-term benefits of real estate than they are about the small victories they can win by working a 9-to-5 job. Think about what you want to do with your life in the future. Are you more interested in working a consistent job that will consistently provide you with money, though perhaps not the salary you wish for, or are you more interested in taking a risk? Many real estate investors seek to retire early. With the money they make from sales and rentals, many are able to maintain their incomes at a relatively automatic rate. Investors make their real estate businesses automatic by hiring people to do the work for them when they vacation in Greece. They can typically continue to make an income long after they're retired. Depreciation. While income is the primary reason most people get in the real estate game, it's depreciation that sweetens the deal for renters. Depreciation is the deduction you get on the rental property when filing taxes. Any money you spend on maintaining your property is deducted as a business expense, which could potentially earn you a hefty refund. To get a better understanding of depreciation, imagine owning a home you rent out to a couple. You are generally happy with their behavior, but occasionally they are rough on the hot water heater or constantly shove plastic down the garbage disposal. The money you spend on repairing or replacing the water heater or garbage disposal eventually earns you tax incentives. Any machine or building you own will depreciate over time. It's inevitable. However, you can capitalize on its downturn, especially if you're an active participant in your business. Active business owners who work more than 750 hours may see a deductible from the hours worked. Passive owners, those generally described as those who only own the business, may not see as many incentives. Equity. Equity is the amount of money your money is worth based on what you have already input. For example, if you have a $100,000 mortgage and have been paying consistently for 5 years, removing $5,000 every year, you have $25,000 worth of equity invested in your home. Now, consider becoming a landlord for a complex that cost you $500,000 with a total of 5 individual apartments in the complex. Every renter pays you $1,000 per month, and no repairs were necessary in the 5 years since you received the loan. Your mortgage requires that you pay $3,000 monthly, which means that you'll have approximately $2,000 extra each month. Assuming you have a side hustle and don't need that extra money for yourself, you can put in that money back into your mortgage and pay off the investment years earlier, not to mention that your tenants paid for the entire mortgage. Consider an example for flipping houses. Assume you take out a $300,000 mortgage loan to purchase a home. The house then takes an additional $30,000 in renovations, leaving you with the bigger debt. However, the house has good bones and can sell on the market for over $500,000. The money you put into the home theoretically increases the equity of the home, assuming you can sell it at market value. Appreciation. Most people who choose to buy rather than rent take on extra expenses to make sure the home is in the best condition possible, not only to provide a better living environment, but also to prepare the way for possible appreciation on the property when they sell again. Homes are notorious for increasing in value every year after they're built, especially if they're kept in good condition. For example, a home built in the 1920s that has been consistently maintained will initially sell for $20,000, but will increase in value to over $250,000 based on inflation alone. Most decades in the past showed an appreciation of a home's value every year, so your home would drastically increase the longer you hang on to it. This is great news for people looking to rent out or flip homes during a period of housing decline, then sell them when the market picks up again. The longer you keep a property in good condition, the more it will attract people looking for your type of home. Many people fail to keep up homes and are subsequently disappointed when their homes fail to reach market value. Leverage. Real estate is the epitome of the leveraging market. When leveraging, you agree to purchase something and retain all of its benefits at a fraction of its cost, which is the method used when obtaining a mortgage. Though you consistently pay the bank back for the investment they made for you, you don't have to share the rewards that come from owning the property. Any extra income you make, you pocket. Leverage is how people with only a little money can afford to get into the real estate game. All it takes is a good history of credit to get a mortgage with a remarkably low interest rate. In most cases, there are even options to help you get a home if you don't have a lot of disposable cash or have a bad credit rating. Real estate is unique in its accessibility through leverage. Consider trying to buy a $5,000 dog in the industry, and you'll have to pay at least a 50% deposit. Utilize this financial opportunity, but beware the problems that arise if you are unable to make payments. So many people have surrendered their homes after major life issues have occurred, leaving them helpless. Make allowances for possible problems in the future by creating a safety fund to fall back on. Portfolio diversity. Any investor worth their salt will tell you that it's incredibly important to diversify your portfolio. That means you should keep your finances in a variety of investments to ensure you don't lose all of your money in one go. People who consider portfolio diversity have already set up investment accounts before they venture into real estate, so follow suit. Have a stable fund before investing. How to invest in real estate. Real estate is a goldmine for those hoping to get ahead, but it can also be disastrous if you don't know what you're doing. Unfortunately, most people fall into that category. They are easily bombarded by the fast-paced environment and can feel like they're lost in the shuffle, easily abandoning their dreams. However, if you know what you're looking for before you invest, you can start making a lot of money quickly. There are several ways to invest in real estate, including real estate investment trusts, online real estate investing, rental properties, house flipping, and even renting out a room. If you're nervous, start small and work your way up to higher risk projects. Real estate investment trusts, REITs. REITs are excellent for people who want to invest in real estate but don't want to spend time looking for the properties themselves. Think of REITs as mutual funds, where companies own real estate and pay you for your investment. REITs can have large rewards but are relatively safe, which makes them prime targets for those in retirement looking to make extra money without putting in the work. REITs can be purchased through online sources, but you'll want to watch your pocketbook. There are scams on the internet that can easily bamboozle people who don't know what they're doing. Public REITs are usually a safer bet, and you can often find out about them from brokerage firms. REITs are considered good investments if you put enough time and energy into finding the right firm. It's hard to know exactly what you're getting when you invest in an REIT, especially since some are non-traded, which means they're harder to find and buy. The best time to invest is highly dependent on what types of REITs you acquire. For example, if the housing market crashes, many people will flock to rentals, which could earn you a lot of money, but times of prosperity will likely show increased likelihood of rented office spaces. Historically, the REITs are some of the best investments you could ask for on the market, with the average return from years 2010 to 2020 listed as 9.5%, Ashworth 2021. Considering that the housing market crashed in 2008, the return is much higher than you might expect. Knowing exactly where to put your money goes a long way in finding an REIT that will work for you. Below are the 5 types of REIT investments and how to invest in each. Retail REITs. Do you remember the last time you went to the mall in your area? How do you suppose that the owners paid to put up such a large building? Retail REITs are some of the most common types because everyone likes to shop. If you live in or near a city, you've likely seen dozens of large retail buildings cropping up, mostly thanks to private REIT investors. However, retail REITs do come with their own risks. Large malls or shopping centers make money from the tenants, but malls have an uncanny habit of whittling down the number of tenants over time. Hard times, like the COVID-19 pandemic, have forced doors to close, not only affecting the tenants, but seriously impacting those holding the REITs as well. Another common issue is the increasing shift to online shopping. Many retailers are now forgoing physical stores in favor of online shops to save on costs. Residential REITs. Residential REITs usually correspond to multi-home buildings, such as apartments. You don't have to be a landlord to own a residential REIT, and some landlords are more than happy when you don't interfere with their work. Instead, you should look out for locations where renting is preferable to owning. For example, New York City and Los Angeles have high rental areas, and people are constantly looking to move to these bustling areas. Speaking of bustling areas, you should also keep a close eye on where the market is leaning in your chosen area. If you invest in a residential REIT in a city that has recently welcomed a lot of jobs, you are more likely to see greater returns on your investment. Follow population growth patterns for the past several decades to see how the economy fares in the area. Keep an eye on companies that are going out of fashion, like some car manufacturing, to avoid putting a lot of money into an investment that won't get you anywhere. Healthcare REITs. You may have not suspected that hospitals and general medical centers are occasionally the result of investors looking to increase their presence on the real estate scene. As the American healthcare continues to increase in cost, investing in a healthcare REIT could be one of the most profitable ventures in REITs. Of course, the success of these businesses relies on how the facilities are funded. You're not likely to find a healthcare REIT in government-funded facilities. The good news is that, as the average lifespan increases, people are in greater need of healthcare services. Look out for locations that are destination locations or family-oriented to find out where elders are more likely to need care. As callous as it sounds, you will also find luck in locations with poor environments. Office REITs. People interested in investing in real estate probably have heard of rented office space. You can get a majority of your money in this venture by long-term leases. Of course, there are some questions you need to ask yourself before investing. Is the economy able to support growth? Are there frequent vacancies at office buildings? Does it make financial sense to attach yourself to an office rental? Often, there are no right answers to these questions. It all depends on the economy in your area. Some locations experience more growth year-round than others, so hitch your wagon to a location with promise. Remember, it's more lucrative to own an average office space in New York City than it is to own prime real estate in Detroit. Mortgage REITs. The most common types of mortgage REITs come in the form of Fannie Mae and Freddie Mac, though there are certainly other establishments that work on the secondary mortgage market. These investments differ from owning real estate, as you are not investing in property. Mortgage REITs are relatively stable investments, but they do come with their own risks. For example, an increase in interest rates means a lower return on investments. There are many mortgage REITs that have promising low-interest environments, but that is subject to change. Before investing here, do your research. Online investing. There are many online investing platforms that will guide you to investing opportunities such as home renovations or financing a wedding. These people need the funding to accomplish goals, but often don't have any liquid assets. Some of the most popular companies are Prosper and Lending Club. In exchange for helping others with their financial problems, investors often get a monthly stipend. However, this method is very risky. If your borrower cannot pay, you may have to shoulder the burden. Unfortunately, it isn't easy to unload these types of investments on others. Another downside to online investing is the good chunk of change you have to contribute to get an investment. Some people looking to obtain financing look at projects that can cost thousands of dollars. As such, online investing sites are only interested in people that can shell out a lot of money at a time. You may have to become an accredited investor to take part in online investing. Rental properties. Many highly successful people made it to where they are because of rental properties, and it's relatively easy to start. If you've ever done it before, consider buying a home and renting out part of it. For example, if you buy a property that has 4 bedrooms and bathrooms, consider renting out the other 3 rooms. This trick, known as hacking, is one way a lot of people make extra money on the side. If done right, you can pay for the cost of your mortgage while potentially earning a little more. Consider properties in your area. Is there a long list of people who would be willing to pay you to rent one of your properties? Do you live in a low-income area or near a university? Younger people are more likely to rent, especially now. Home prices are rising higher, and many people can't afford to take out a mortgage. While you can set someone else as the manager of your new estate, it's best if you take the lead, at least for a few years. You'll start to understand the business more fully, and you'll get a leg up when searching for new properties. Managing your own properties means that you know the market and what to charge to keep your expenses below the price of rent, which is invaluable knowledge. Before you dive in, consider these tips and questions. Are you landlord material? Sure, it's all fun and games until your renters destroy a washing machine and make you pay the exorbitant fee in repairs. If you don't know how to use tools, you'd probably best not participate in this type of investment. The amount of money you will spend on outsourcing your problems will ultimately eat up your profits and leave you hemorrhaging money. Unless you have more than 1 or 2 properties, you'd better figure out how to do a lot of home repairs. Of course, if you're not handy and you have a good chunk of change lying around, consider investing in multiple properties. Hiring managers and handy people at your rental properties to manage the problems for you is often a smart move. Once you get the hang of rental properties, you can even expand your rental radius to other cities or even states. Avoid debt. If this is your first time investing, it's likely that you'll have to get funding from a local bank, but don't let that be your only source of income in the future. Try to reduce debt as much as possible in the first few years of owning the property. You may find that your real estate side gig will run your life if you don't get your payments under control. If you have any additional debt, such as student loans, car payments, or medical bills, it's unwise to invest in rental properties. Though rental properties will earn you money, they'll only increase your income to debt ratio and leave you paying extremely high monthly payments. Plus, if the market crashes and you have no renters for your property, you'll be out of luck with huge payments to consider. Get a down payment early. Financing a large rental property is not as easy as it sounds. While you could possibly get away with giving a 5 to 10% down payment for a home, the bank will expect at least a 20% down payment for a large facility. If you're not sure you can get the financing before you begin your search for a rental property, it's best to wait. Starting small is also a great option to get your foot in the door. Location, location, location. They say that the 3 most important things in real estate are location, location, location. Getting an amazing building with all the amenities in a poverty-stricken neighborhood will likely result in monetary loss. Find a place where there is still room to grow, just as you would when purchasing an REIT property. Though the mortgage may be at the top of your list of payments, remember that it's hardly the only thing. For example, property taxes in the state of New York are extremely high and could cost you an arm and a leg, even if you get the property for cheap. Also, people are less likely to rent property in high-crime areas, places with little access to public transportation, and locations with depleting populations. Buy or finance. So, you found the property of your dreams and are unsure what to do about it. There are typically 2 options: buy or finance. Deciding on which one you want all depends on what your investment goals are. If you buy the property outright, you'll receive positive cash flow immediately and could see significant progress in buying your next rental property. However, if you finance the home, there is less of a financial burden on you, and you can still see incredible earnings over the course of a year. Calculate for high interest rates. In the mid-1900s, the interest rate for a home was incredibly high, some reaching to 20% to 30%. However, with the new millennium came lower interest rates. Unfortunately, some lenders will still try to take advantage of people who are new to the game and are unsure of what interest rates to expect. Compare mortgage rates before deciding on one lender. Also, take into consideration the amount of money you'll have to spend on monthly payments. Just like any other market, the housing market's interest rates fluctuate depending on the time of year or year itself. What you might have been able to afford several years ago may not be an option today. Of course, there is always the chance that you can refinance your mortgage, but don't use that as your only criterion for using a mortgage with a high interest rate. Landlord insurance. Today, there is insurance for nearly anything you need, including pet insurance, so it shouldn't surprise you that landlord insurance is available. If you are renting a property, invest in it. Renters have a tendency to trash homes that don't belong to them, and you may find that there are several holes in the walls where there weren't any a few years earlier. Tenants may also try to sue you if you don't take care of maintenance issues, especially if they are dangerous. You'll also need to purchase homeowners insurance, but you can often couple this with landlord insurance to keep the prices low. Just as you would for mortgage rates, contact multiple companies to find the best in your area. Remember, if you choose a large company online, the customer service may suffer, leaving you in a lurch. Analyze unexpected costs. Say you purchase your first rental property and let the tenants bring a dog into the home. Years later, when they finally leave the property, you find that the dog has destroyed most of the home. If you don't have extra cash to use, you could find yourself taking out a second loan to fix up the place. Of course, not all unexpected costs come from tenants. Most locations in the United States have possibilities for natural disasters. Check for earthquake, tornado, hurricane, flooding, or landslide zones. Other common natural disasters include wildfires and high winds. If you're not prepared for these possibilities, you'll likely learn quickly that you should have a backup fund. Natural disasters mostly happen without warning, so you could be shouldering a bill for a repair that was unavoidable if you'd done your research. Buy low. If your first investment is $1 million home, you'll likely not have many customers knocking at your door. Also, if you're just starting your real estate business, you may be surprised at how long it takes for people to rent from you, especially if you don't have any reviews online. To maintain cost, stick with a smaller home or apartment building before you move on to bigger homes. Of course, you don't want to go too low when investing in your property. Many properties that fall under the characterization of real estate-owned REO properties, you can bet there's something wrong with them to reach a rate that low. If you're new to handiwork, you might find yourself in a lot of hot water if you're trying to do all of the work yourself. Your best bet is to find a reasonable home that requires few repairs and little upkeep. Flipping investments. Have you ever seen hit HGTV shows that flip homes for money? There's a reason why they're popular, and it has little to do with the prices they pay to get the homes, and mostly to do with the money that they can get from them, and how they can make them beautiful. If you're handy and love having a project, you can start your own flipping company and make a lot of money. Of course, not everything is as easy as it appears on television. To be successful when flipping properties, you have to make accurate estimates of what the home will cost you and how much you can get in return. Buying foreclosed and low-cost properties is also a high-risk venture, as there's a possibility that you'll pay more to repair the house and sell it than you can get from it. Also, during low housing markets, it becomes much more difficult to sell a home, even if it's the top of the line. You may have to expect that the home will be on the market for several months before someone snaps it up. Just as with rental properties, you have to know where the market is high for home buyers. If you get a steal, but it's located in downtown Detroit, there's not a great likelihood that you'll get buyers to come out of the woodwork. High levels of crime, cost of living, and tax rates all play a factor into if someone will purchase your home. So, before you start flipping, do your research about the area and market trends you see in the area. The best way to begin flipping homes is to establish your army of professionals that will help you get the most out of your money. A real estate agent is vital to knowing the market and finding deals. A real estate attorney can give you legal advice about the area and draw up contracts that will satisfy your needs. An accountant is imperative to keep the books straight, give you advice on what homes you can purchase, and how you can improve your finances. A reliable home inspector can give you the gist of what is wrong and right with the house. Finally, a title inspector will let you know if there's anything wrong with the title, such as liens or back taxes. Once you get your team ready, flipping homes will be a lot easier. Renting a room. If you're not entirely sure how to get started, but you really want to try, start by renting out a room in your house. For those who are really worried about who might show up, remember that you can always dip your toe in the water with websites like Airbnb. You won't require a long-term commitment, and you are always in control of what happens to your place. What's more, many companies offer some sort of protection to guard against visitors that trash the place. Chapter 2: 401k and Retirement. What better way to save for retirement than to let your 401k do the saving for you? Most employers have a retirement plan that will match whatever you put in, and your taxes wait until you draw from your funds, building your equity. That means that your employers will pay you extra to invest in your future. Most young people don't want to think about what will happen when they get older. It's easier to imagine that you'll eventually get where you're going while you play poker with your friends than it is to actually work more to put more money in the bank. However, when you reach middle age, if you haven't already started saving for your future, now would be the time to start. Your 401k and retirement plans could grow exponentially with little input on your part, so it's time to save. Why saving matters. The retirement age was set in the early 1900s, and it hasn't changed since. Why? Some speculate that it has been set in stone for so long that to change it in any way would seriously impact how you save for retirement today, which it should. In the early 1900s, retiring at the age of 65 meant that you had another year or so to be supported by the government before you passed on. However, with ever-increasing lifespans, the retirement you accrue doesn't spread as far as it would be in the past. Though how much you save for retirement is up to you, you shouldn't assume that you'll marry rich or get your money from a large inheritance. You should also assume that Social Security will not be enough to get you through a month, let alone your entire retirement. It's now up to you to save as much as you can before you retire to live comfortably. One of the most common forms of retirement savings comes in the form of 401ks. You can build a retirement by saving a small percentage of your income, and it won't seriously impact your monthly income. Of course, there are more advantages to starting a 401k than to simply save money for your future. Here are some of the most common reasons to take part in this amazing plan. Tax advantages. Who doesn't want to legally avoid taxes? Well, with a 401k, the money you save is not taxable at the time it is withheld. That means that if you contribute $1,000 to your 401k every month, $1,000 goes into your 401k, not whatever is left after taxes are taken out. The money you put into a retirement plan is not officially counted as income, so you'll have fewer taxes coming out of your paycheck as well. When you do your taxes at the beginning of the year, whether you itemize or choose a standard deduction, you can still be counted in a lower tax bracket. You will eventually pay your taxes on your 401k, but that only happens after you withdraw money. So, why would you want to postpone paying taxes? Well, you'll likely fall into a lower tax bracket when you retire, which means that you won't have to pay as much as you would if you had a steady income. Control over finances. Having a 401k means that you are entirely in control of your finances. It doesn't matter if you contribute 1% or 20% of your earnings into your plan. You can change that amount at any time. It all depends on how much you're comfortable with saving. However, remember that some plans have limits on how much you can invest at one time. If your employer is matching your 401k contributions, you may have to settle for saving a lower percentage than you would like. Time is your friend. What if you were able to invest some money into your future and leave it for years, only to come back and find that it had increased exponentially? Luckily, a 401k is a great place to start compounding interest. In essence, your money makes more money over time. If you're starting to save for retirement at a young age, you may find that the money you put in when you're 25 will more than quadruple in 40 years' time. And the more money you put in, the more your money will grow. So, how does compound interest work? For an example, let's say that you put in $1,000 into your savings with a 5% interest rate compounded yearly. By the end of the year, you'll have $1,050. At the end of the second year, your principal of $1,050 will have compounded again to give an additional $52.50, and you didn't have to do a thing. By the end of 40 years, you'll have $7,040, more than 7 times the amount with which you started. Of course, with a 401k, you'll likely make yearly, if not monthly contributions. With your job matching your investment rate, you'll start to see your investment increase rapidly over time. It's not easy to not touch such a large amount of money, but if you keep your hands off of it, you could see a massive increase in your bank account by the time you retire. Take it with you. It is so frustrating to work in a job that you hate only to find a job that you love paying the same amount of money. You'll have to leave all of your hard-earned money behind to change careers. Well, that's not the case. Even if you decide to change jobs, your 401k stays with you. Some old employers let you leave your 401k with them when you change jobs in the belief that you'll come back for it. Many employers will give you a wide variety of options regarding your investments and give you advice on how to move it. In most cases, you can incorporate your old 401k into the new one, simply picking up where you left off. Payroll reductions. Adding money to your 401k and retirement plans is so easy that it's hard to believe that many people don't use this option. Whoever is in charge of payroll will take care of moving the investments to your account, and some of the options of letting you decide how much to take out of your paycheck. All deductions are added to your account before you get the rest of your money, so you won't even notice it's gone. Maximize your 401k. If you haven't started to save with your 401k, there's no doubt that you'll want to start now. However, this easy retirement plan often comes in a statement that is dull and difficult to understand. So, before you give up on saving with the 401k plan, follow these ideas to give you the most bang for your buck. Types of 401k funds. There are many types of 401k funds, and most are under the mutual fund category. Mutual funds refer to investments pooled among several investors towards a common goal, such as stock options. These mutual funds range anywhere from low to high risk, and the outcome corresponds to the risk. So, low-risk investments, though safer, will yield you smaller returns than high-risk investments. Whatever your preference, it's important to know what you're getting yourself into. Conservative fund. If you're the type of person who loves to play it safe, conservative funds are for you. The money you place into your funds will garner interest, but it will likely move slowly. However, there is something to be said about predictability. You'll probably not have to worry about where your money is going. Barring a total world economy breakdown, you can rest assured that your money will continue to accrue interest. Value Fund. Like the conservative fund, the value fund offers a safe investment for consistent growth. However, these types of funds offer a greater return than conservative funds. In the past, the money was invested in guaranteed investment contracts, GICs, that were primarily contracts between investors and 401k companies. However, during the stock market crash of 2008, it was determined that these types of value funds were junk and offered no return. Now, value funds primarily consist of government and corporate bonds. Value funds will most likely change interest rates over the course of their short maturation cycles. However, 401k companies often purchase insurance to ensure that the interest rates don't dip too low. To ensure that the income remains stable, many 401k companies sign with multiple insurance companies. Unfortunately, value funds often charge annual fees to pay for the extra insurance. They are also less liquid than some of the other fund options. Balance Fund. The next step up the risk ladder is the balance fund. Balance funds are named after their balance between equity and debt. These funds are riskier than the two previously mentioned, but they still offer a relatively safe investment due to their mix of stocks and bonds. Balance funds include investments in two or more assets, each with their own maturation dates and risk returns. Most people who choose this option are looking for an option that will supplement their incomes on a fixed budget. Unfortunately, not all balance funds are created equal to help you build your 401k, which means you might have some troubles with tax allocation. If you're looking to invest in a balance fund, talk with your employer and accountants to find the best options for you. Balance funds usually require more finesse than other funds, which may eat up your time and provide you with bad results if you don't know what you're doing. Aggressive Growth Fund. The Aggressive Growth Fund is for people who are looking for a way to make a lot of money in a short period of time. Of course, this method is extremely high risk, which means that you could end up losing most or all of the money you put in the account if the market or business tanks. Consider, for example, two companies that both had promise, Apple and Enron. Enron was the darling child of Wall Street in its heyday. It was a personal finance company that used mark-to-market accounting to inflate the numbers for its success. Unfortunately, its increased numbers were not accurate, causing it to fall quickly. On the other hand, Apple started from a garage and only grew up in value over years of work, finally culminating into what it is today, an empire. Both companies looked promising in the onset, but both had radically different outcomes. Specialized Funds. In the center of risk for all the funds listed above comes the specialized fund. Specialized funds refer to mutual friends that are niche specialized. For example, you may find burgeoning stock options and bonds for markets in technology, pharmaceuticals, or any other emerging markets. Target Date Fund. Unlike the other types of funds listed above, the Target Date Fund is a structure that strives for optimization by a certain time frame. Target date funds are long-term investments that change over time to reach your goals. For example, if you wanted to start an aggressive fund strategy at the beginning of your career with a more conservative fund at the end, you would invest in this type of fund. Portfolio managers often work closely with clients to ensure that needs and expectations are met. Keep in mind that if your goals are not met, your portfolio manager may move your investments in conservative funds to more aggressive funds. While this might pay off, it could also leave you in a world of hurt. Global and domestic investments are ever fluctuating, so there's no direct path to success. Diversification. Just as with real estate, it's important to diversify your 401k account. You could choose a variety of investment niches, or you could simply spread your money around in a variety of stocks and bonds. By diversifying, you're ensuring that you'll still have money to work with if one stock or bond fails. If you're very adventurous, play around with the different types of investments. For example, if you're just getting your feet wet, combine a conservative fund with an aggressive fund. Remember, you're not alone when choosing what funds you want. Reach out for help to find which one suits you the best. If you find you prefer one type of fund over another, stick with it for a few years. One of the best ways to increase your diversity is to use a strategic asset location. Just as the name implies, your goal is to move your assets to where they're most effective. Of course, with this method, you must remember to hold on to your assets for a significant amount of time. If you buy and sell at the drop of a hat, you're not likely to make any money. Follow the trends of previous years to see where you put your money. So, if previous years showed a 5% return on bonds and a 10% return on stocks, you could expect a 7.5% return on a 50-50 split. Another common tactic is to use a constant weighting approach, which gives you the freedom to change up your investments on a more regular basis. If you're more confident in your abilities to make good financial decisions, this may be the right choice for you. The idea is to balance your portfolio as you go, but don't change so often that your investments don't have a chance to grow. Stick to the 5% rule. If one asset changes by 5%, change it and balance the other assets accordingly. New investors looking for a way to spend their money without losing it all may find that the insured asset allocation method is the best. In essence, you're in charge of your finances until you dip below a base you set. At that point, you will consult with your portfolio management team to assess what to do next. If you're looking for a method of investing in your 401k, but aren't confident in your abilities, this method can give you the reach and the opportunity to grow your investments. Whatever way you decide to diversify your 401k portfolio, you should be aware of how much you can afford to lose and how much risk you can take. A lot of that knowledge comes from your own research, but utilizing people who specialize in the business is equally as important. Avoid high fees. Unfortunately, there are fees that come with your 401k. The Department of Labor posts what fees are associated with each aspect of your 401k. How many fees you pay depends on the company you choose, and choose carefully. For example, if you started a balance of $25,000 in your 401k with no further input for the next 35 years and an annual fee rate of 0.5%, your account would grow to $227,000. However, if you increase the fee amount by 1%, you'll see an end result of $163,000, a staggering $60,000 difference. COP 2021. In some cases, there are fees that you really cannot change or maneuver around. The fees are associated with the deal that your employer made with the 401k company. You're awarded information regarding the fees on your 401k, but there's not much you can do in the way of avoiding these fees. The two types of fees you'll see are plan expenses, which are set aside by your employer, and fund fees, which are determined by you. Plan expenses are meant to keep your 401k company in business, which they handle to ensure that you maintain a retirement plan. Your fund fees, however, are used to keep your portfolio manager's pockets lined. You must pay a certain amount in commission to those in charge to make sure that they make the right decisions regarding your portfolio. Of course, the amount of fees you're willing to pay reflects the amount of attention your portfolio receives. Funds with high management fees usually do a lot of research regarding the best investments to make. If you're part of an aggressive fund, you may want to invest in higher fees. However, conservative funds will give little payout and take a lot of your money in fees. Index funds are the least managed funds, so they're also the funds with the least in fees. You may not expect to find that an index fund only requires an annual fee of 0.25%, while a more managed fund may run you to 1% in annual fees. Of course, the best run programs will have incentives to invest in their funds, so you're likely to see lower rates and better websites from these companies. How much to invest? There is no clear-cut way to determine how much you should invest in your 401k monthly. It all depends on your age, location, and retirement plan. If you are in your 20s, you won't have to invest very much at the beginning of your 401k. But if you're nearing your 50s, you may want to consider adding a sizable chunk to your portfolio every paycheck. Also, consider how much your employer is willing to match your investments. Most employers will offer to match half of whatever you invest up to a certain percentage. For example, if you put 10% of your paycheck into your 401k, your employer may match 5% of that investment. In essence, your employer is giving you more money to invest in your future. Always consider how much money you'll need given the state of inflation. If you're more than 30 years away from retirement, consider that you'll need at least double what you could live off of now. The more you delay your gratification, the more you'll see in return for your hard work later on. Low-income tax benefits. If you're concerned about savings due to low income, take advantage of the Saver's Tax Credit. This tax credit will give you a non-refundable credit on your taxes up to $2,000 per year if you're single, and $4,000 if you're married when you contribute to your retirement. So if you take advantage of this tax break, you'll see your tax burden decrease in two ways. One is with the credit, the other when you contribute to your retirement plan. Eligibility for the Saver's Tax Credit is determined on age and how much money you make. You need to be at least 18 years old and make under $33,000 for a single taxpayer and $66,000 for married taxpayers, COP 2021. Keep in mind that the numbers for eligibility change yearly, so you may qualify for next year's tax return if you don't qualify for this year. Keep in touch. This may sound simple, but many people who invest in their futures forget to keep up with their investments and can let good-earned money go by the wayside. You could find that, after a few years, your portfolio needs revamping, allowing you to rebalance your portfolio to give you the most income. Remember that you may need to replace some of your best performing assets with others. Though this may sound counterintuitive, it's simply good investing. Your favorite stock could be for a company making banana toothpaste, but your best performing asset may be in technological advancement. Simply place some of the money you spent on the banana toothpaste company and invest it in technological advancement. However, keeping in touch doesn't mean that you should always have your hands in the pie. If you follow the principle, buy low, sell high, you may be cheating yourself out of a lot of money if you don't hold on for a certain period of time. A great example of this is Apple. While many saw the rocketing sales of Apple and have attempted to sell their shares, those with good business sense held on, and it's one of the most profitable companies to date. Your 401k is your retirement fund, and you should treat it as such. Don't dip into your funds when you can't come up with money for the month. Instead, plan out your retirement future before you set up a certain percentage for monthly allocation. Set aside enough money to pay for bills first, then move to build a better portfolio. Making 401k selections. All of the information listed above can seem daunting, especially if you've never invested before. However, there are ways to make sure you make the most of your investments, and it is as simple as a few steps. Follow the steps below to find the best 401k selections for your future. Step 1. Plan document. Your plan document is the first place to start when making your selections for your 401k. This document is given to you by your employer and outlines everything associated with your account. It will include the employer matching program and other details about your retirement plan. Before you do anything else, thoroughly read this document. It may change depending on if you have children or get married, and who to contact when you have a life change. Included in your plan document is a vesting schedule, which lets you know when the money in your account is fully yours. The money that you put in your account is yours, but you're not guaranteed your employer's contribution until you've worked there a few years. Think of this as an insurance plan for your employer. They want to make sure that you're making the right choice when investing in your future. If you eventually leave your job for another one, you can take everything with you. Step 2. Beneficiary Designation Form. On the more morbid side of starting your 401k is the Beneficiary Designation Form, which tells your 401k manager where to send your funds if you die. If you're married or have kids, this decision is often easy, but it's still important to remember to check on this every once in a while. Some people fill out this section quickly and then forget about it for years, but life changes can seriously impact your decision. For example, if you were married when you filled out the paperwork, but divorced at the time of your death, your ex will receive all the money from your 401k. Other problems, such as the birth or death of children, can cause your money to end up in limbo. So, check up on this at least once a year to make sure that you know where your money is going. Step 3. Enrollment Form. The enrollment form is the place to set the percentage of your earnings you want to go toward your retirement, but there's more to it than that. You can choose between a standard pre-tax 401k or a Roth 401k. The Roth 401k takes taxes out of your savings before they enter your 401k. If you don't like the idea of taking taxes out of your earnings later in life, sign up for the Roth 401k. However, not every employer offers this option, so you may not have the choice. Some 401ks also offer automatic rebalancing, which refers to a portfolio manager's ability to rebalance your investments yearly to give you the best deals. In essence, your manager will buy low and sell high to give you the best profits. Automatic rebalancing is recommended to anyone with an aggressive fund. It never hurts to have a professional's opinion about your finances. When you call your portfolio manager, make sure you're talking to a person and not a machine. Step 4. Investment Options. Every employer should have a document that tells you exactly what your options are for your investment. Don't get overwhelmed with the information. Instead, slow down and find which investments work best for you. Remember, you are in charge of your earnings, so you can play around with the types of investments you want. Employers will occasionally try to push target date fund investments on you, but you'll have little control over what happens in your portfolio. If you want to see greater returns, you should have control over the type of funds you choose. So if your employer tries to tell you to take advantage of target date funds, ignore their advice and build your own portfolio. Step 5. Pick the right funds. This is where it gets messy, with people who don't know what they're doing. Luckily, you have this book to outline what each of the funds will be and how they can benefit you. If you're starting your 401k early, you can play around more and dip your toes into more investment opportunities. Remember that many people choose to talk with portfolio professionals outside of their companies to find the best deals possible. You may have to pay more money to get an expert's opinion, but it'll be worth it in the end. After all, the money you make from a plan that has high returns will more than compensate for the consultation fee. Chapter 3. Starting a Business. Starting a business is hard work, and it could mean putting in a good chunk of your own change. But that shouldn't stop you from creating your own business. With the best business practices listed below, you can navigate your way through the rough patches in a business startup to immediately begin investing in your future. Why start your own business? Starting a business can be scary, especially if you never even considered it before. Sometimes it takes a leap of faith to start in your own business because you'll be the sole financier for the job. However, what's better than having your own business? You are not a slave to the alarm clock, and you can become more invested in your interests. Of course, as with any venture, it takes time and hard work to get what you want, but it can really pay off. Here are some other reasons to take the plunge and start your own business. Motivation to succeed. Have you ever woken up in the morning and felt like you were meant for something more? If you're constantly thinking about how to impress someone else to make money, your motivation will wane significantly. It's difficult to muster the energy to know that you're not following your dreams. However, when you start your own business, you become more motivated to succeed. As the owner of a business, you have to take on a lot of risks. You have to pay for equipment, marketing, and rental space, among other overhead to consider. However, you also get to keep all of the profits you make. When you start your own business, you are in charge of its success. So, if you put in enough elbow grease, you'll see your business start to succeed over time. Shouldering the risk has another benefit. You'll have the motivation to keep your dreams afloat. With more risk comes more excitement. You can find new avenues to improve your customer base and constantly learn new things. When your company's success depends on you, it's a lot easier to get motivated to be productive. If you're starting a business with a partner, you can give each other motivation to keep going. Remind yourselves of the reasons for starting the business. Remember how you wanted to improve your financial circumstances and work for yourselves. A business partner can bolster you up when you're not feeling positively about your business. Set yourself up for success by writing down why you want and what you want, and spread it around your new office. You'll soon find that if you believe in your cause enough, others will too. When you have the motivation to succeed, you'll find new ways to improve your business. Follow your passions. Most successful people have a passion to start their business because they have a passion about the business. An excellent example of this is Elon Musk. Ever since he was a child, he had a fantasy of living in Star Wars and experiencing science fiction in real life. This led him to create SpaceX, and now he has made billions of dollars from his passion. Of course, you can't expect to make billions of dollars right out of the gate. That said, there's nothing stopping you from making as much money as you want from your passions, as long as you have a good business model. Though there is a lot of trial and error that comes from setting up your own business, don't be afraid to fail. You'll learn far more from your failures than you will from your successes. So what if you don't have a specific passion, more of a general interest? There is more to be passionate about than a business. If you have the desire to improve the lives of your family, start your own business. If you're looking for a way to open opportunities for yourself in the future, start your own business. Your passion could be the desire to learn more, and that's a great place to start. For others. So starting a business is great for yourself, but what about others? Well, with your own business, you can become more fulfilled in society. For example, you can sponsor your own local baseball team, or give back to charities that aid in community help. There are many charities, local and global, that are always looking for donations. An excellent example of this comes from Manhattan. A teacher with the desire to help people in need founded a food truck called Snow Day. She received inspiration from a student with a criminal background who said that he couldn't become what he wanted to in life because of his juvenile record. It became a matter of pride for Jordan Lexton to help students' juvenile records to get jobs by giving them jobs on the truck. With your own business, you're free to be as giving as you want, and that often comes with tax benefits. People are always saying that they want to do something for the world, but you could actually make that happen. It all depends on how hard you work to achieve your dreams. Financial independence. Have you ever looked at your boss and wondered what it would be like if you didn't have to report to them anymore? What if you could have financial freedom and still get to live independently from everyone else? Starting your own business can be highly lucrative if you do it correctly. There are many startups that suffer from extreme setbacks in their first years on the road. In fact, you can't start a business expecting to make money right away. You usually have to wait at least a year to make a profit. However, once you get through the rough patches, you have given yourself an avenue of success for the future. There is no limit to how much you can make when you work hard enough. Your business will also become an asset over time. The more money you put into the business, and the better it succeeds, the more likely you are to make money from it consistently. Also, if you ever decide to sell your business, your success will encourage others to buy your business. If you make your business successful without your constant supervision, you have an even greater chance of selling it for a lot of money. Control your lifestyle. Sometimes the grind of living one day to the next under the thumb of your employer can feel like a terrible weight on your shoulders. After spending years doing the same thing, it can feel like you're stuck in a rut. However, if you feel like you want to break free of the consistent 9 to 5, opening up your own business will give you the freedom to work when you want, where you want. When you're stuck at a desk job, you don't have the flexibility to work around your crazy schedule. However, with your own business, you can schedule meetings and family events without consulting your boss first. No one is forcing you to meet deadlines in your own business. Everything you do is under your own control. Keep in mind that, for most businesses, it's difficult to have a completely flexible schedule. You still have to work hard and meet your quotas for the day, just as you would as an employee. It's difficult to structure your time if you're not used to setting your own schedule. You'll have to find time to make sure everything gets done in a day, which is hard work. Starting a business is not for everyone, but it is extremely rewarding once you develop a system. Start from scratch. If you ever looked at your life and weren't completely satisfied with everything you found, you're not alone. However, starting your business also means starting from scratch, and you can develop your business the way you think it should be run. Starting from scratch is scary at first, but once you find your niche, it becomes much more enjoyable. Starting from scratch also means that you can design your company in the way that you believe it should run. Maybe you found the rules and regulations constricting or your employers too rigid. In your own business, you can develop your own way of doing things. Find out how to improve productivity while giving people a chance to have fun with the company and their families. If you weren't satisfied with the wages that others paid you, starting a business could be a great opportunity for you to develop you to start your workers off at a good wage. Tax benefits. It's true that, when starting out, you won't make as much money as you will in later years, but there are other things to consider as well. For example, you can take advantage of office-based tax deductions, which includes furniture, equipment, office supplies, software subscription, cell phone charges, meals, and others. The home office tax deduction is where you'll get most of your money back. Of course, you must have a space in your home used solely for your business. If you're not sure what you can get from this tax deduction, visit an accountant. All of the supplies you use for tax deductions can be cashed in for your current tax year or 7 subsequent tax years. If you want to take advantage of the 7-year plan, you'll be deducting the depreciation on the supplies. You may find it helpful to use the 7-year plan if you're still financing your operation for a few years. That way, you can spread out the costs. Driving your car for your business means a tax deduction. You can deduct all finances related to the car, such as mileage, gas, repairs, and more, all in the name of your business. Of course, you'll have to keep track of your movements in the car. The best way to maximize your vehicle tax deductions is to consult an accountant. They will be able to tell you if your expenses count as business expenses. Health insurance can also be tax deductible, as long as you're not on someone else's plan. You have to finance your own health insurance to reap the benefits, but it may be worth it to get off your partner's health insurance. Any premiums you pay come out of your taxes. However, you may have to make concessions with health coverage for your spouse and children. Not all additional health plans are tax deductible. Jack of all trades. Many people see a jack of all trades as a slight on their expertise in one area, but you shouldn't take it in that way. Becoming a master of multiple skills takes a lot of time, but you'll be putting that time into your business, and you'll naturally become better at a lot of skills. As a business owner, you may be required to run HR, do inventory for your shop, and learn expert knowledge about your field. You'll learn the ins and outs of marketing and how to become a people person, especially if you're selling something. You may even need to invest in learning basic graphic design skills. Whatever the skill, repeated use in your business will ensure that you've learned far more than you ever thought you would in a short amount of time. What to have before starting your business. As wonderful as it is to start your own business, there are some things you need to have before diving right in. Starting a business is hard work, and it requires a lot of risk and concessions on your side. The best way to start your business is to be aware of what you need before you even begin. Time. If you already have a full-time job and commitments on the side, you're not going to have enough time to start your business. If you're working on the side, you may be able to get away with working less than a 40-hour week at your new business, but be aware that it will take some time for the business to grow if you started that slowly. The rules change slightly if you don't have another source of income, because you have to put in more hours. If your company is going to succeed, you need to be willing to work more than the 40-hour standard work week. In fact, you may even need to put in 16 hours or more every day to make sure that your business succeeds. Most companies go out of business in the first 2 years because they don't realize how much hard work is involved. You have to be fully committed to your new business. Money. Unfortunately, most things come down to money, and starting a new business is no exception. If you're not prepared to spend any money, your business won't make any money. Successful businesses require equipment, websites, licensing, regulation costs, and insurance, among others. In fact, for just a micro business, you should have at least $3,000 to put in right away. Weedmark 2020. If you're planning on having a business support your family, expect to spend more. If you can't get away with paying for your business yourself, you have a better chance of success. But that doesn't mean that you can't succeed by borrowing. Try to make enough money each month to offset the cost of payments for the company. That can be a tall order, especially if you're not putting in full-time work. Keep in mind that it's best to find investors that are excited about your business. Don't run to your family to find financing for your business. You won't appreciate it as much, and therefore won't have the same amount of motivation as you would if you had financed it yourself. Expertise in your market. What about your product or service do other people want to buy? It's important to know exactly what people want from your business and to find a way to market to them. If you already have experience in understanding your product or service's market, you are halfway there. However, if you're not sure what people are looking for, do your own research. There are millions of great ideas that don't make it through the market because business owners didn't know how to market them. Find a professional in your field and have a mentoring session with them to get a better idea of your situation. Business skills. According to Mario Peshev, the CEO of Devrix, an SME digital consultant, the 10 most important skills to have when starting a business are curiosity, time management, strategic thinking, efficiency, resilience, communication, networking, finance, branding, and sales. Forbes 2017. These essential business skills will help you navigate through some of the most difficult periods in your business, and you'll have difficult times. However, not everyone is skilled in all 10 of these areas. That's where outside help comes in. Every skill you don't have on your own can be found in other people. It's also possible to learn these skills through hard work and research, so pick your poison. You may have to sacrifice either time, money, or both to attain these in-demand skills. When you learn these skills, you may find that you need to create business in a different field, expanding your horizons. Be ready for risk. Starting a business is risky. Many people who have started their own businesses have seen many of their own businesses fail in the past. Jack Ma, the man who started Alibaba, saw several of his businesses fail before Alibaba stuck. In fact, if you look through history, you're likely to see more failure than success in business. The people who eventually succeed are those who stick with it until they found a venture that would support them. You're lucky if your first business is a success, but that doesn't mean that you should quit after a few failed attempts. If you keep going, starting your own business can become incredibly rewarding. Plus, you have already worked out a lot of the kinks associated with business building. How to improve your small business. When you're starting a small business, it's important to constantly make improvements to adapt to your market and to give you easy cash flow. Remember, that you're not likely to have expertise in all of these areas, but that's where professional help comes in. It may seem like a waste of money to hire professional help, but you'll ultimately get more out of help from others than you would if you did the work yourself, especially if you're not a master in your field. Below are some of the most important ways to improve your small business. Keep track of finances. Many startups fail to do this one simple step, which leaves them in a world of hurt. So before you even buy your first paint roller for your job, set up an account that can give you accurate information about your finances. It will let you know if you need to cut back on some expenses or take time to fix problems that are hemorrhaging money. Of course, the best way to do this is to hire a professional accountant, but there are other ways you can keep track of your finances as well. Open a bank account. No, you shouldn't have your personal bank account work as a bank account for your business. You're more likely to spend money where you don't have it, and it becomes far more difficult to make distinctions come tax season. Companies and banks that see you have a business account are more likely to give you approvals for loans or financing in the future because you have good financial records. Remember that you should put at least 25% of your income aside for taxes. When you're getting a paycheck from month to month, it's easy to forget that your company has done all of this for you, but as the owner of a small business, it's your job to make sure that the government gets its share. Do your research when it comes to procedures for your small business, which heavily depends on your state and country. File all of the paperwork necessary for your location and save the documents. Some places are more friendly to small businesses than others, and if you're serious about your business, you may need to consider moving to get the most out of your business. Consider setting up a business credit card to earn credit. If you're looking for financing, there's little more important than credit. Even if you only make small purchases, use your credit card at least once each month. It's not required to get a business credit card if you're not planning on your small business becoming a corporation or LLC, but it's always a good idea to build credit. Track expenses. It's impossible to know how well your company is doing without constantly checking on your monthly expenses. How much overhead do you have? What expenses are deductible during tax season? How has the business grown over the past month? Your business is only as effective as your bookkeeping is. Every receipt you receive should be stashed away for future use. In this day and age, there are online organizing systems that can help you store important records. The IRS doesn't require receipts for small purposes, but it's always smart to keep track of every expense you have. The most important types of receipts to keep are for meals and entertainment, business travel, vehicle expenses, gifts, and home office receipts. All of these expenses are tax deductible, and they could save you a lot of money when you need it the most. If you're just starting out, try to stick to only a few of these expenses, like home office supplies and vehicle repairs to save on money. If you have any expenses that count as both personal and business related, you must include that on your receipts. For example, your cell phone use, though at least partially business related, is likely also to be used for personal use. Personal use items are not tax deductible. Develop a bookkeeping system. Bookkeeping differs from accounting because of the time frame and overall expertise. While accounting is about looking at the numbers for your business over a series of months or years, bookkeeping is the day-to-day expense report system. Even if you've never done accounting in the past, bookkeeping is fairly simple. You just need to know how to record transactions, categorize them, and then make sure your numbers match those on the bank statement. There are several ways to do your bookkeeping. You can do your own with software such as QuickBooks or Excel. You can hire someone to do it part-time, or you could hire your own full-time. Keep in mind that to hire your own professional bookkeeper, you'll need to make enough money from your business to cover the cost of salary and benefits. When doing your own bookkeeping, it's important to know whether you want to use the cash or accrual method. The cash method shows the results of the transaction when you get or give the money. The accrual method records when the transactions actually go through. For the accrual method, you'll need to ensure that the money you are recording actually goes through. Setting up payroll. If you're just starting out, you won't need to worry about hiring multiple people to help you, but as your business grows, you'll need more help. Before you hire your first employee, ensure you have all the paperwork necessary to pay them and do taxes along the way. Luckily, there are a lot of software applications that are designed just to help with payroll. It'll help you know what to pay your employees after taxes and keep track of how much you're paying your employees. If you're hiring multiple contractors, you'll likely need to set up their own account. Most independent contractors are required to fill out 1099 forms every year. Understand how you'll get paid. If you're hitching your wagon to a third-party payment business manager, such as Shopify, they can give you a pretty decent understanding of how much you'll take in every month. They'll even set up accounts that will accept credit cards. However, you can also choose third-party payment gateways, such as PayPal, to get the money. Of course, you may have to pay an extra fee to use these services. You'll need to set up your own business accounts before you can start taking transactions. Establish tax procedures and know your tax obligations. Taxes are tricky, so you'll need to understand how to calculate tax for every customer that buys from you. If you're starting a physical business, the tax problem becomes a lot easier. You only need to charge tax for the state in which you reside. However, if you're selling merchandise to people around the United States, you have two options. You can charge tax for the state in which you reside or tax for the state in which the purchaser resides. Even in Canada, you have to pay attention to where you're sending your merchandise. Luckily, if you have revenues under $30,000, you don't have to worry about individual states yet. However, the greater your income, the more money you'll have to devote to paying taxes in other states. Selling internationally is often easier than selling domestic. In the United States, you don't have to tack on taxes to your purchases. However, there are some states that take the sales across borders more seriously. So before you decide to make every international sale tax exempt, make sure you talk with your accountant. There may be hidden taxes or fees. When you're just starting out, you can claim the money you make from your business on your personal tax form, but it becomes more difficult when the business becomes a corporation. Even if you're the owner of the corporation, you must have two different tax forms for yourself and for your business. Self-employed people are responsible for their tax collections, so you're required to hold on to taxes until tax season. Americans are expected to pay taxes quarterly, but Canadians that owe more than $3,000 can pay taxes in installments. Murphy, 2020. Whatever your circumstances, it's best to just set aside a quarter of your earnings to be safe during tax season. Set goals. You'll be infinitely more productive if you can set goals and keep them when starting a business. Set both short-term and long-term goals and see how far you've come after a year of work. Not only will you increase your motivation, but you'll see where you need to improve in the year to come. But how do you set a goal that is effective? The following tips will help you achieve even the most ambitious business goals. 30-minute goal cheat sheet. Many people get caught up in believing that goal setting is a difficult process, but it doesn't have to be. In fact, you should be able to crank out excellent goals in just half an hour. Keep these goals where you can see them at all times, and commit to fulfilling them. Of course, that may mean that you have to create smaller checklists to make sure your goals are met, but it's worth it to meet your goals. Set SMART goals. If you haven't jumped on the SMART goal train, it's time to try it now. The concept of SMART goals has been around for a few decades, and it has continued to stay in practice because it's the most effective way to set goals to date. When you follow your plan, goal setting becomes easier in the future. S. Specific. When you set your goals, have a clear outline of what you expect to do and achieve. For example, a specific goal would include where you'll get your money and how you plan to implement every cent. Your goals should be well thought out, if not long, to make them more achievable. M. Measurable. A measurable goal is one in which the word someday is not involved. You should treat each goal like a measuring stick. Every small goal you achieve on the way to your ultimate goal is easy to knock off your list. You may find that measuring your goals in days is more effective than months. Whatever your time frame, you should complete your goals in increments. A. Achievable. Achievable goals are those that are not out of the range of possibility. For example, a goal to make $50,000 in your business before the end of the year is far easier to achieve than making $1 million. When your goals aren't achievable, it can be a serious strain on your motivation. R. Relevant. Have you ever tried to achieve a goal in which you had no experience? You often find yourself over your head and drowning fast. Before you set a goal, make sure you fully research how to get there. You don't have to have experience in achieving the goal in the past. In fact, there are many resources that provide detailed research about how others have done it, so glean wisdom from them. T. Time-bound. Once again, you don't want the word someday printed on your goal sheet. Every goal you set, both short-term and long-term, should have a time frame that is achievable. For example, you could set a goal to make a sale every week as a short-term goal and to make over 52 sales over the course of a year. Define business goals that inspire. It's impossible to start a successful business without a business plan, so start by making goals that inspire you. Business plans have a reputation of being long and boring, but they don't have to be. Your goals don't have to include how you'll grow your business in the next year. They could simply be gaining more knowledge or improving your connections. However, if you're looking to make some more money, one way to inspire you is to define goals that improve your bottom line. You could either lower costs or increase the number of sales. Unfortunately, this can be challenging, so make a game out of making more money. Get involved with people who have succeeded in their business in the past. Find ways that you can be more productive. When starting a business, it can feel like you never have time for anything else. So see what you can do to improve your productivity and spend more time doing the things you love. Learn to love your planner, have fun in color coordinating, and putting in important information in binders. Finally, use technology to do a lot of the heavy lifting for you. You will feel more inspired to do work if you know that you only have to do a small portion of it. Let your online shop do a lot of the marketing and statistics for you while you spend time doing what you love. Master presentations. For many, public speaking is one of the most difficult chores to overcome, but it's essential when starting your own business. You have to show others that your products are worth buying. That means you'll have to improve your public speaking skills and use technology to get your point across. Create presentations that will inspire others to look for your products or services. Presentations are also vastly important when pitching ideas in an investor's meeting. You could have the best products or services in the world, but if you can't communicate that to your investors, they're likely not to give you any money. You have to believe more in your business than anyone else, because if you don't believe in your business, why would anyone else? Monitor trends. You can't know where you're going if you don't know where the market has been. Luckily, there are many online sources that can tell you what is trending right now and how to capitalize on it. Go through Google Analytics before you decide on how to proceed with your business plan. If you have a physical location, go to the stores in the area and find out how they're doing in the market. These people can often give you more information about what's happening in your area than anyone else. They are an incredible resource, so don't forget to ask a lot of questions. Master the art of selling. Selling can seem like a difficult hurdle to overcome, especially if you have troubles talking with people. However, learning how to sell is relatively easy, and anyone can learn to do it efficiently. Below are some things to consider when selling your products in person or online. Customers are the number one priority. Have you ever worked with someone who was trying to sell you something but didn't take your thoughts into consideration? Successful salespeople can create a foundation with their customers before they begin trying to sell a product. They know that return customers are those who believe they are best listened to. The key is to put yourself in your customer's shoes. Why would you want your customer to buy your product? Are they going to tell your friends about your product, or better yet, about your shop? Not every customer is friendly. In fact, you'll meet your fair share of customers who are downright nasty. However, if you want to succeed, you have to focus on giving even the worst customers the best service. Sales is about the numbers. You're not going to feel successful if you only talk to one customer per day. The fact is, many people that you talk to, at least in the beginning, are not going to be interested in your product. You have to wade through the denials to get the few yeses that will keep your business afloat. Remember, you're not going to be a master the first time you sell something. You'll have to work out a method that works well for everyone. If you're new in your field, talk with someone who has been there before. Having a mentor is the best way to learn quickly and efficiently. Train yourself. If you're not used to cold calling people, your first phone call may go something like this. Hi, would you be, interested in trying my product? Your phone conversations will be a lot more awkward if you don't spend the time looking in the mirror or in front of a friend practicing. There are even sales courses and helps both locally and online. So if you're serious about making a difference in your sales pitches, apply for some of them and practice the principles often. When you spend as little as 20 minutes every day practicing your craft, your numbers will vastly improve and quickly. Analyze your competitors. What is it about your competitors that keeps their customers coming back again and again? It's not a shady business practice to analyze what your competitors are doing right and doing wrong. In fact, that's how most business is improved. When you see a want from a client that isn't being fulfilled by your competitor, you can fulfill that need and make it better. Below are some tips to help you better research your competitors. Delve deeper. Most people researching their competitors stop at doing a Google search for the other companies. True, you'll see some of the basics of the business and flaws that are most visible to the eye, but you won't get to the meat and potatoes about how another business works. Discover your competitor's ability to market by studying their search engine optimization (SEO) techniques. Some of the best spying tools are available online. For example, SpyFu lets you know what your customers are searching for. Google Trends lets you see where else your customers are looking online. Google Alerts can keep you up to date on your business, but also your competitor's company. Find out about your industry. What are people saying about your industry? When you routinely check what masters in your business are saying to customers and what customers are saying about them, you can mold your marketing to them. You can find out what is trending and discover problems in other systems. Use social networking. Some people exclusively do their marketing on social media because it's free, accessible, and there are millions of people on them. The most popular are Facebook, LinkedIn, Twitter, and Instagram. Monitoring what your customers are saying about your competition on social media gives you a great insight into their minds. As you've no doubt experienced, people on these sites are often brutally honest. Use that to your advantage. Other great reviewing sites are Yelp and CitySearch. These sites can give you information about competitors' deals. When you provide newsletters and information regarding deals on your own site to match your competitors, you'll get more attention from customers. In fact, you might be able to attend competitors' product launches to see how they market and to use their methods against them. Ask customers. Some of the best information you can receive is from new customers. Ask them why they switched to your company. More often than not, they'll not tell you what they didn't like about an opposing company. When you do enough research, you will get a general sense about not only your prime competitor, but those who might not have thought of. Get enough stories to warrant making changes in your shop. Chapter 4. Stocks and Trading. Stock markets are known for being tricky. It's impossible to predict the exact movement of the stock market, so there's a certain level of risk associated with stocks and trading. However, the richest people in the country have relied on stocks and trading to increase their income for decades. It has become such a profitable venture that if you can do it correctly, you can make millions without going to a full-time job. If you have a 401k, there's a good chance that you dabbled in stocks and trading, even if it was primarily passive. However, the more you get involved in the process, the greater your chances of success in the field. So, if you're looking for a way to make a lot of money in a short amount of time, try your hand at stocks and trading. Why invest in stocks and trading? If you're like the majority of people in the United States, you've probably had doubts about the stocks and trading system. After all, after the stocks fell at the end of the 1920s, the people who invested in stocks and trading took a significant hit. However, if you know what you're doing, you're more likely to make money than lose it when browsing your stocks and trading options. Investing is easy and affordable. When most people start investing, they're often surprised about how little money it takes to truly get started. If you put aside just a few dollars a day, you'll start to see money add up over time. After a month of saving just $3.30 every day, the price of a coffee, you'll have saved $100. Setting aside only a small amount of money each day is painless and extremely doable. Once you've invested in a stock, you have the option to simply watch your investment or to add to it consistently. You'll likely not see a lot of money come from a single $100 contribution to your stock, but you'll start to see significant gains over time if you reserve that daily $3.33 to your stock. Many new investors take in a divided reinvestment plan, DRIP, that will automatically make contributions to your stock for you by purchasing new shares. Though this service comes at a price, it can save you a lot of money over time by avoiding broker fees. Your purchases are made through the stock companies instead of a broker's firm, essentially cutting out the middleman. The beauty of using the DRIP plan is that your stocks will accrue consistent money over time. However, remember that taking part in a DRIP program means that you're putting all your eggs in one basket. Occasionally, this method can be fruitful, but if you choose a stock that is low performing or fails over time, you could be out of a lot of money. As any stocks and trading professionals will tell you, keep an eye on your investment and make changes as you see fit. Outrun inflation. Inflation is the bane of many investors for the simple fact that their money becomes less powerful over time. Inflation is the principle that guides the price of milk and eggs. Though you could previously buy both for under a nickel, now you'll have to pay upwards of $5 for the same purchase, a 1,000% increase. For example, if you had a plan to purchase a home after 5 years without accounting for inflation, you're not likely to make the down payment. What's worse, for traditional investments such as certificates of deposits, CDs, or saving accounts, the gains you make will fall short of keeping up with inflation. The United States tries to keep the inflation rate around 2% every year, so hold that as a standard to your savings account. Even with a high interest rate, most saving accounts don't accrue interest greater than 1%. Some institutions even charge you a percentage of your withdrawal when you take money out of a CD before it has fully matured. Maturation periods can last a year or more, so if you're in a pinch and you need some cash, you may be consigned to getting less money out than you put in. However, when you invest in stocks and bonds, the money will increase with the rate of inflation. Depending on the returning interest, you could see an aggressive stock's interest at around 15%. Of course, not every stock will give you such a high percent of return, but you can expect to make more than you would putting your money into a savings account. Grow wealth. Investments in stocks and trading takes a lot of work and requires a certain amount of skill. Luckily, if you're not familiar with the industry, you can get a majority of your information online or from professional brokers. There are many resources that can help you make a lot of money without forcing you to dip too deeply into your pockets. Remember that, although purchasing stock in the next Apple would give you a significant return, there are more companies out there that can give you a very good return without skyrocketing. Many people get frustrated when they realize they won't make thousands of dollars within the first few years of investments, but don't let that stop you. Most investors have seen at least a 10% annual return on their stock investments, little 2021. While it's true that there is no guarantee that the stock market will continue to rise, you can check the S&P 500 to determine the validity of your choices. Keep in mind that this estimate of annual return also takes into account the various crashes over the years, so some years you may see a significantly greater return. The market works for you. If you're the paranoid type, or have at least seen A Beautiful Mind, you may think that there are some aspects of the universe that are out to get you. Luckily, the stock market isn't one of those. The stock market does not behave according to how much work you put into your job this week or how much money you added to your mutual fund. Of course, that also means that there is no magic key to help you make good investments. The best advice anyone can give you about the stock market is to do your research. You can often determine how well your stocks are going to do on the market by determining how well they've done in the past, and that goes for technology and grocery store stocks. So, to get the most out of investing, learn as much as you can about the basics. If you see your stocks follow a trend of failure, there's no definitive course of action to follow. You'll often hear professionals, and even those new to the market, tell you to buy low and sell high. For you, that may involve investing in a startup or taking advantage of a downturn in the economy. However, you won't know just how well your project can perform if you don't sit on it for a while. No doctorate degree required. The best people in the business are those that stuck it out, so you don't have to be extremely wealthy or have an advanced degree to do well in stock investment. The requirements to invest in stocks are far lower than they are for developing a small business or even investing in real estate. Research the companies in which you want to invest. Spend time on their websites and searching the internet for information about their business strategies. Remember that something as little as employee satisfaction can play a role in determining if a company is going to succeed. If you have a lot of faith in the company, others will likely feel the same way and continue to invest. However, learning the stock trade can be difficult, especially if you're not particularly interested in your investment. If you choose a stock in the beginning technology field without showing at least a moderate interest in either the engineering or business side of it, you'll likely resent the stock you bought. Even if the stock performs well over time, you're not likely to sell it at the right time, and you could lose all the money you put into it. Picking stocks does take a little bit of math, especially addition, subtraction, multiplication, and division. However, even if you just know the basics, you're more likely to understand more complicated concepts by researching. Modern stocks will often have an option to do minor calculations if you're struggling to determine your returns. Take your time. Unlike a majority of other investing options, you can take your time when investing in the market. If there's not anything that grabs your attention right now, don't worry. There will be something that will show up soon. Remember, you should be actively engaged in your investment, so don't think that you can't hold off until you find an opportunity that will support your dream. Take the time to set realistic goals. Though many people get into investing in stocks and trading believing that it's a get-rich-quick scheme, that is rarely the case. Do your research and be realistic in your expectations using the information on hand. Consult professionals to find out how to improve your strategy. There are multiple investing simulators that can give you an idea of what you should expect before you enter the market. Go through several of them before investing your own money. You'll see a market increase in your successes, and you don't have to spend a dime. How to invest. If you're looking to earn some money on the side or want to completely exchange your current income for investments, investing in stocks and trades is a great way to earn extra cash. One of the simplest ways to invest is to find a broker and let them do the work for you. However, if you're looking to get more involved in the process, follow these steps to learn how to invest. Decide how to invest. The first step in investments is understanding which approach to take. The options depend on how involved you want to be in the investment strategies, ranging from completely hands-on to completely hands-off. Each option has its virtue, so look into several options before making up your mind. Brokers. Brokers are professionals with the sole purpose of helping you get as much out of your investment as possible. Most brokers get a commission for finding the best investments, so they are literally paid to find you the best deals possible. Experienced professional brokers can often make you a significant amount of money in a short period of time. Stockbrokers are your best resource for advice. Day trading can be one of the most lucrative professions. As a result, it drives the most talented people to the industry. Of course, day trading is a fast-moving environment, and most people don't make it unless they learn quickly. So, hiring a professional usually means that you're hiring someone who's worked the system and won. If you want to completely be hands-off, stockbrokers will do the work for you, buying, selling, and offering trades on a wide variety of options. The more a broker is involved in your profile, the more they will require in commission, but it may just be worth it to take the risk on a professional. Brokers are excellent at keeping records, and you'll need that for tax season. Brokers know the ins and outs of taxes, and they'll often send you monthly statements and inform you of any changes in your portfolio from the last several years. You can always judge a good stockbroker by the records they keep. Your broker can be as hands-on or hands-off as you like, and you can typically create a plan that will work just for you. Remember to keep tabs on your stockbroker to make sure that you're getting the service you want. If you're unsure about a specific stockbroker, start off small and increase the investments over time. Robo-advisors. Robo-advisors are becoming one of the best ways to invest. They use computer algorithms to build your portfolio, ensuring that you're getting the best information on trends in the past few years. There's no human interaction, so all services are usually done online. Some companies will provide human advisors to help you navigate the programming and answer some questions, but robo-advisors do the heavy lifting. Robo-advisors are relatively low cost, and you can start with a low initial investment. Online portals also make it easy for you to start quickly. Once you make your investment, you're added to the system and can track changes. Some robo-advisors claim to show you results in 24 hours. When you start with a robo-advisor, they will typically have a questionnaire to help you determine which investments best fit your requirements. Most of the time, you'll receive a choice of stocks from a list of 5 to 10 choices. Choose what works best with you and veto the rest. Choose the investing account. The type of account to set up depends entirely on the route you want to take on how to invest. If you're looking for a broker, you'll open a brokerage account, and for a passive option, you'll look for a robo-advisor account. They are both easy to set up and come with their own perks and options. Brokerage account. A brokerage account is the quickest option since you'll be doing a majority of the work yourself. If you're looking for a more extensive list of things to include in your portfolio, contact a professional. You can open a retirement account or a taxable brokerage account, which is the best option if you're already satisfied with your retirement plan. You can purchase as many brokerage accounts as you like since you own everything in the account. If you're just testing the waters, however, start with just one and get as much advice as you can from a brokerage firm. If you want a stockbroker to do the work for you, do your research to find out which one will benefit you the most. Once you open the account, transfer funds from your checking or savings accounts to send to your brokerage account. Once you have a significant amount of money in the account, you can invest. If given the choice between a margin and a cash account, choose the cash account. With a margin account, you borrow money from the broker's firm, but you'll have to pay interest. Robo-advisor account. The first step in setting up a robo-advisor account is to find out how much risk you're willing to endure. If you can handle a high-risk investment, you can make considerable money, but you could also lose a good chunk of it. Most initial investors choose a conservative amount to test the waters. Don't worry if you don't know yet, you can always change your mind in the future. Set at least $1,000 aside for investing. Though there are robo-advisor accounts that can take less than $500, it's always good to have more on hand. You'll make more money over time. After you add your investment to the account, the robo-advisor does the majority of the work. Robo-advisors usually charge 0.25% of your account balance, O'Shea and Davis, 2021. That may seem like a big investment, especially if you're just starting to invest, but that percentage is relatively conservative. There are many face-to-face brokers that will charge a much higher percentage to do the work for you. Know the difference between stocks and funds. Mutual funds are the most common types of funds, and they involve purchasing small portions of a variety of stocks. Mutual funds are safer than their stock counterparts because of their diversity. You could own a portion of Apple and Google at the same time, but only small portions of the stocks. Keep in mind that mutual funds require you to make the purchases with several other investors. Individual stocks are typically riskier, but they could pay off significantly if you choose a winner. Owning stock is like owning a small portion of the company itself. However, stocks are more expensive than their mutual funds counterparts, so you'll need to be willing to part with a good chunk of change to diversify your portfolio. There are upsides and downsides to each option. You'll likely see consistent growth with a mutual fund, but you probably won't see meteoric rises. An excellent example of increasing wealth with stocks is Bitcoin. In the last decade, the stocks have skyrocketed, making those who invested early extremely wealthy. However, you could also get stuck with a stock that crashes. The greater the risk, the better the return, or worse, the plunge. Set a budget for stocks. It can be tempting to throw a lot of money at stocks, especially when you see examples of people having incredible success, but you still need to budget. Those who fail at day trading often do so because they become too invested too quickly and lost all of their money in one fell swoop. Below are some tips to make a great budget for stock investing. Calculate your net worth. Find out how much money you make each month and how much money it takes to support your lifestyle. If you have a standard 9-to-5 job, just look at how much you make after taxes. Next, determine how much you make in a year, including how much you have to pay in taxes. Next, assess your assets by adding up all of your retirement accounts, the price of your home, and any other liquid accounts. Add your monthly expenditures, which includes all necessities, like utilities, home or rent payments, insurance, etc. Finally, add your flexible expenditures, such as entertainment. Be specific and write down all individual expenditures, instead of just lumping them together into a single category like home. If your number is negative, you may have to do some rearranging to bring it back to a positive number. Add all debts to your account, which includes student loan debts, credit cards, and car loans. There are multiple apps that can help you add up everything you own and help you organize your debts. Usually there is some wiggle room in the amount of money you spend on accounts, and most people can cut out flexible expenditures to save just a few dollars every day. Set financial goals. Your financial goals should be as specific as you make them. If your goal is to pay off student loan debt or to save up for an emergency fund, write down how much you'll need every year and work backward. Backward calculating helps you know how much you need to save daily to reach your goal. So, if you want to pay off $10,000 in debt by the end of the year, you'll need to save $833.33 every month, or $27.78 every day. Find out how much you can live on. Budgeting scares off a lot of people because it's difficult to say no to your favorite expenditures. However, if you set up a financial roadmap, you can achieve any financial goal. The first step is to find out how much money you need to survive every month. Keep in mind that just surviving off a monthly budget is not sustainable, so add some flexibility for expenditures. Make a spreadsheet of what you'll need to spend in every expenditure. Try to cut back on the number of times you eat out or go to get drinks with friends. Make sure your goal is something that you really want to achieve. Just as with New Year's resolutions, many people abandon budgets after a few days because they're hard to maintain. Keep an eye on your goals at all times by posting them all over your house and asking your friends to keep you honest. Set goals in your planner and stick to them, despite the voices in your head telling you that you can splurge on that extra slice of cake. Find out how much money you'll need to start investing. Once you've figured out your budget, you can start to think about the stocks you want to purchase. Stocks shouldn't add to your financial hardships, so make sure you take care of your debts before you invest in stocks. Set aside the previously agreed upon dollar amount each day to reach your goal for each month and year. Depending on what type of investing you want to do, you could only need a minimum of $1,000 or need more than $10,000, so plan ahead. Again, there's no need to rush when purchasing stocks on the market. Take your time to save up to the amount you want to invest. Remember to diversify your portfolio when you can reduce risk. Focus on long-term gains. The stock market rises and falls over time, and if you panic and remove your investment too early, you'll likely miss out when it inevitably increases again. The key to any successful venture is to stick with the strategy and let the money come in for you. Believe it or not, the best way to do this is to not change at them as often as you'd like. Check up on them monthly or semi-annually. How to improve your trading skills. The reason that so many people fail in the art of trading is because people are often not precise enough to work the numbers. Though there is some chance involved in trading, the fact is that most of it has to do with the skills you have going into the trade. Here are some of the most important ways to improve your trading skills. Have a trading journal. As much as you like to believe that your mind is a steel trap, the fact of the issue is that you can miss a lot of key insights because you just forgot them. The passage of time usually takes a hit on memories, and you can't rely on it to keep all of the important information needed to start a successful trading business. Your journal should be separated into two accounts, one for everything you've done in the past, and the second to determine the flows in the trade. List all your records in chronological order and write down everything you think you might need, including the average points for the day, the companies that raised the highest, and those that tanked. Keep this first half of your journal as accurate as possible, which means that you shouldn't add speculation. The second half should have charts that show trends for all the companies you have. Identify peaks and valleys and when the best time to invest is. All your decisions should be made on facts, not from what you once heard someone say. Remember, stock trading is mostly a numbers game that takes a lot of chance and even more accuracy. You can usually accurately predict most economic changes, which includes the trends of the nation. If politicians are pushing an issue, you can bet that the companies that adapt to the change will likely increase as well. Get help. Even if you don't want to enlist a professional to help you work through a majority of your work, it always helps to have someone else look at the information and give you a hand. Often, you miss small things that you could have easily found if you had a look at it again, which is why it's excellent to get a second opinion. If you do look for professional help, set up a system that allows you to do most of the work in the future. Professional stockbrokers can give you a game plan to follow, and you can make your own adjustments as you go along. Even if you don't choose to utilize a professional frequently, invest in having one look at your plan at least every 6 months. Practice. They say that practice makes perfect, but practice actually makes permanent. If you practice the wrong way, you'll see poor results every time you visit your stocks. So, the best way to start off on a good foot is to find a strategy that will help you practice the right way. Some people choose to use pen and paper to do most of their practicing, but some of the most successful day traders got their start with risk-free day trading simulators. Look online to find the best simulator for you. Most simulators are either free or low cost, but even those that require some compensation are worth the investment. After all, you're investing in your future, so it's worth it to get the best possible tool to help you succeed. Purchase trading software. Trading software is enormously helpful, especially to those new to stocks. Trading software lets you track and analyze stocks, bonds, and a host of other investments, working as a cheaper option for a stockbroker. Trading software also allows you to make trades in any location instead of calling into your broker or traveling to Wall Street to make your claims. Of course, if you're invested in working with a professional, many brokerage firms actually allow their clients to use trading software for either free or for a small charge. Those new to trading will most likely find the concept of stock and trading analysis foreign, but trading software does the hard work for you. Trading software comes in two kinds: commercial platforms and prop platforms. Commercial platforms are typically used by those who want to do a majority of the work themselves, including day traders and retail investors. Prop platforms, on the other hand, are used by large companies. Usually, prop platforms contain features that are relevant to specific businesses. All trading software should include an order placement option which allows you to make purchases in real time. Some software will show you the trends in chart format, while others will give you a list. All orders will let you know the approximate win rate for that stock and what you can expect to win or lose by investing in it. Technical analysis is another common feature in trading software, giving you a mix of charting and financial indicators. Even if you're not a financial wizard, you can often make sense of what these charts say. However, it's wise to research what your technical analysis entails. The more you know about the technical analysis on your software, the more you can improve your trading. Some software offers the option of programmatic trading, which makes trades for you automatically. Luckily, this feature is often accompanied by a demo that lets you practice before you make your first purchases. You can adjust the programmatic trading in the settings and play with the features after you've found a setting that works best for you. Trading software also includes paper trading, which allows you to practice without purchasing any stock. Like indicated in the practice section above, this feature is vital to the improvement of your business. You can also usually adjust your strategy based on the settings provided in paper trading. What trading software you want depends on how much you want to consult a professional. Some software has extra features that allow you to visualize your strategies before you put them into action, reducing your need for consistent professional help. Most brokerage firms will also allow you a chance to try out the software to see what works for you. Study the people who run the industry. If you can't get Warren Buffett as a personal mentor, you can always read about him online or in books. These people will give you new angles in the market and make you think about ways to get ahead of the crowd. Stories of their successes often come with data that will let you know how they got where they are today. Take risks based on your budget. How much of your risk can you actually afford? If you're putting a second mortgage on your home to fund one of your trading ventures, you're doing it wrong. Remember, trading is addictive, and most people that fail in the field do so because they took risks too big for their budgets. Before you dive too deeply into any investment, set up an emergency fund. Set aside enough money to last you 3 months before investing in any stocks. For the most part, your stocks will go through up and down swings, so you may have to live off of your emergency fund during the hard times. When you do get money from your investments, set part of it aside for that emergency fund. Constantly think about diversifying your investments, which will reduce risks. Some stocks perform better in some seasons than others. Some companies will come out with new products at certain times of the year, making the prices of stocks increase significantly, but fall the rest of the year. If you're just starting out, try investing in both conservative and aggressive stocks. As with all stocks and bonds, it's important to do research before you decide on any one stock. Find people who support the stock and find out why it's important. As a hint, if only employees are interested in a company stock, there's a good chance that it won't yield much in the way of returns. Create standards. The stock market is filled with companies who have a shot at making it big, but not every company will show you the gains you want or suit your budget. Have standards for your stock purchases before you even begin your search. Find out which stocks you have the most faith in and base your standards on that. It's difficult to put together a list of standards everyone should have when it comes to stocks because it varies with every person. Let your standards reflect your personality and trading style. If you're looking for a company that is very data and detail oriented, your personality should match that. Differentiate rumors and data. The stock market is full of rumors of successes and failures, but they rarely lead to legitimate aids. You should always view rumors as background noise in your business. Unfortunately, it's impossible to escape the rumor mills completely, so you'll just need to learn to turn a deaf ear to whatever is said. You can usually tell what is true and what it isn't by looking at reputable market news sources. Though you might panic when you hear that your stock is going to plummet, wait until the data is out. It can seem irresistible to sell some of your stocks and invest in something more lucrative, but you could be making a huge mistake. There are thousands of examples of people who did just that and lost a lot of money. Part of the reason for the Great Depression had to do with speculation in the stock market. Because the stock market was fairly new to many, any news, both real and false, influenced many in the industry. Unfortunately, when many heard of the news, they pulled out their finances to save themselves, which lowered the price of other stocks on the market. The resulting crash led to one of the most influentially bad financial crises in United States history. Today, there are more safety nets to make sure that such a crash won't happen again, so hang on to your stocks when you start to panic. The chances are that your stock will improve over time. Even if you do see a dip in the stock market, it doesn't seem that a rumor was correct. Just wait it out. Try new strategies. Playing it safe is one of the most common styles of living. In fact, a great many people stay at jobs they hate because they don't want to deal with change. However, if you're going to succeed in the trading business, you need to embrace changes and occasionally try something new. Much of the change won't be on purpose, but you'll have to learn how to go with the flow. Successful day traders are notorious for being flexible and learning new skills when necessary. If one strategy isn't working for you, try something else. If you're not sure what to try, consult a professional. As the world continues to change, so do strategies for day trading. So even if a strategy works for you now, there's no guarantee it'll work 5 years from now. Chapter 5. Physical Investments. When you think of physical investments, you may think about great chests of gold or jewelry that's hidden in a vault. And though there is some truth to that, there's more to physical investments than pirate treasure. Most of the time, the people who invest in physical investments choose to do so because it brings them joy to own unique or antique pieces. Whatever your reason, there are plenty of ways to get involved in physical investments that will satisfy you for years. Invest in art. You've likely seen a piece of art that has dramatically increased in value over the course of its lifetime. For example, when Vincent van Gogh tried to sell his paintings, he was often laughed off. But today, his paintings sell for millions of dollars. If you are an excellent art collector, you could have millions of dollars hanging in your house. Remember that every piece you purchase will need time to accrue money, so art is more of a long-term investment than those listed above. Investors typically wait about 10 years or more to make sure their investments increase in value enough to sell. Bergen 2020. In fact, you'll likely see that art collectors hang on to their investments their entire lives, leaving them to their children. When you find a painting that will make you significant cash, you'll have to watch the market for the perfect time to sell it. Unlike the stock market, there are typically no valleys and mountains in the investment charts for art. Good art will also continue to increase in price as time goes on. However, unlike many of the investments discussed previously, art is notoriously risky, especially if you're not already familiar with art pieces. Some people pay professionals thousands of dollars to make sure that their pieces are originals, because copies are virtually worthless. So if you're comfortable with taking on some risk in your investments, try investing in art. Why invest in art? Because there's significant risk involved with art collecting, it's hardly a profession for the timid, which discourages many potential investors. However, there are several reasons why investing in art is worth the risk. Here are some reasons why to consider investing in art. You like art and aren't looking to become rich. Perhaps the simplest reason to invest in art is that you enjoy art. Most art collectors start in art investments because they like art. They typically go to museums when visiting new cities or countries, and they may even be inspired to sit in front of art pieces for hours for inspiration. If you like art enough to put some in your own home, you may find that art collecting is your calling. Most art collectors start with 1 or 2 pieces they really enjoy and only add to their collection when they have the funding to do so. Remember, you should consult with a professional before you invest in art that could be potentially worthless. However, if you're purchasing the piece just because you like it, you may not mind if it's not worth a fortune. First and foremost, find pieces that suit your aesthetic and then look at how much you can make from them. Of course, it's not easy to determine if you can make a lot of money on the art you possess, so don't rely on it as your only source of income in the future. With art, don't invest in any pieces that you couldn't handle losing in an accident. If you're only interested in art because of the potential money you could earn, look for other investments. Collecting art is an art in and of itself. You have to have an eye for work that is both inspirational and aesthetically pleasing. If you're buying art just to check it off a bucket list, you're unlikely to see warning signs. You like research. Just as you would for any of the other investments listed in this book, do your homework. Most of your information you can find on the internet, but there's a lot to be said about consulting a professional. Reach out to art collectors or museum curators to know how much your piece is worth. Look in museums and famous collections to see if you recognize any names. If you find a Jackson Pollock piece that hasn't been displayed in the past, you've likely got your hands on a gem. You can do your searching both in person and online, as most places have a virtual viewing room. When you find the names of professionals, find out if they've won any awards in the past. Your best bet to find an expensive painting is seeing how much recognition the artist has received. How to invest in art. Though it does take some money to invest in art, you can start your collection at a relatively easy price if you know what you're doing. In fact, there are professions that are dedicated to finding rare art pieces at a bargain. Know originals versus copies. If you find an original piece of art, you may have your hands on gold. Originals are one of a kind and increase in value over the years. In many cases, originals at auctions go for millions of dollars if they're from famous artists. There are art collectors that pride themselves on owning only original pieces. Giclée, a print with superior quality, will likely fetch more money than its print counterparts. In fact, these quality copies occasionally come with certificates of authenticity and may make it into museums. Though the quality is great, Giclées are still copies, not worth nearly the price of an original. A slightly less valuable form of painting is a print. Prints are generally produced so people who have tight budgets can participate in buying paintings. In some cases, prints can increase in value, especially if they have historical value. Limited editions are also known to significantly increase in value, especially if they are signed by the artist. However, there's no guarantee that a print will appreciate in value, so be careful. At the bottom of the totem pole is the reproduction, which is often seen as posters. You can usually find these in gift shops, and they have little to no value. If you're just getting started as an art collector, you may find these as great alternatives to the high-priced paintings, but you'll never make a fortune with reproductions. Research the artist. When you research an artist, you'll likely find out more about how many awards they've won, but there's much more you can learn about them from that. Buyers like to know the history of the artist, particularly why they created what they created. The backstory brings the art piece to life, and investors are interested in understanding as much as possible about the artist. Knowing more about the artist's life is also an incentive to buy a piece of art. Some artists had to go through significant struggles to create their work, while others achieve their visions under some influence of drugs. People like a good story, and art puts an image to that story. Research the artwork. Before you purchase a piece of work, do some research about it. Find out where it came from and who the seller is. If nothing else, you should do thorough research into its authenticity. If you can, contact the artist to confirm the artwork's origin, but you can often also contact family members if the artist is dead. Art specialists should be able to tell you if a piece is an original if they know enough about the artist. Find out if the artwork is damaged. If it is, it may be worth significantly less than what the seller is prepared to take. If it's only slightly damaged, you can often get away with doing extensive repairs to restore it to its former glory. However, if it's significantly damaged, there may be no way to salvage it. Remember, too, that it requires a great deal of money to restore art pieces, so you may be putting more money into the artwork than you'll get out of it. Discover when the art was created and where. If the artist is famous, it's usually fairly easy to find information about it online, but there are also many art experts that can help you find the right information. The age of a piece significantly impacts its price, depending on the artist. Investigate the dealer. One of the most common mistakes new art investors make is not looking into who the art dealer is. There are many dealers offering prints of the original at the original's price, and it's very easy to get caught up in a charismatic sales pitch. Find out the dealer's reputation in the community and ask them for references. Small art dealers are often difficult to substantiate, so just be extremely careful. One of the best ways to determine authenticity and to ensure an honest dealer is to go to an art exhibit. Galleries often display their top artists and can give significant information about dealers and the artwork itself. Most of them have online viewing galleries to help you get acquainted with the pieces and the artists. Trust the advice of professionals and those in the art world who are connected by word of mouth. Caring for art. Since the artwork is highly dependent on how well you can take care of it, always take extra care in its handling from the dealer to your home. Before you touch the art, wash your hands and wear gloves. Don't wear any jewelry that could get snagged on corners of the artwork, causing it to tear. Make sure to hold the artwork firmly and ask someone else to assist you with particularly heavy pieces. For paintings, it's easy for the canvas to stretch or tear with heat or contact with sharp objects, so place it in a location that will keep it free from the elements. When dusting your artwork, use an artist's brush, something that is large enough to get the work done, but not too large that it can't hold its integrity. If any part of the piece is damaged, take it to a professional instead of cleaning it yourself. Many times, buyers are tempted to use chemicals to get out stains, but this will only damage the artwork, so leave it alone until you can get a professional. Keep your piece out of sunlight where it will fade and likely cause damage to the canvas or paint. Also, remember to keep it away from any type of water or dampness, so a cellar is a bad place to store it, even if it's off the ground. If you're storing your artwork for long periods of time, invest in something that will keep everything separated. The more your artwork rubs against other pieces, the more likely it is that the work will get damaged. Selling artwork. Becoming an art dealer is often a lot of work and can take up a lot of your time, but there are other ways to sell your work. Find a venue that is accessible to as many people as possible, and either make a deal with a gallery or sell it at an auction. Most venues have some charge associated with the sale, so look around before you settle on one spot. The more you sell your artwork, the more likely you are to create a network that will increase your chances of selling to more customers. Go to as many art galleries and museums as you can to find the best people in the business. If you're interested in one particular artist, follow those who specialize in his or her work. The final place to sell artwork is on the internet. There are online auction sites and art stores that can find new homes for your pieces. Of course, just as with the venues listed above, there is usually a price tag associated with posting your art on the site. Make sure that the site is well known and respected. There are some sites that will simply try to take your money and leave your artwork off their pages. Some sites also require payments for the number of days your artwork remains on the site, so shop around until you find a good internet shop. Invest in jewelry. Now is the time to visualize the overflowing chest of jewels you might find on a deserted island. Jewelry is a great investment, especially for people who are looking to purchase something exotic. There are 5 main categories of jewelry: necklaces, pendants, rings, earrings, and bracelets. They can come in a variety of metals, stones, or other materials that make them completely unique. Why invest in jewelry? One of the best perks of owning jewelry is its ability to increase in value over time if it's made of precious metals or other enduring metals, so you can almost guarantee it will increase in value over time. You'll also see a wide variety of jewelry that ranges from the exotic to the simply beautiful. Below are some reasons why you should invest in jewelry. Durability. Precious stones and metals don't disintegrate, and they're also known for retaining their shape for centuries. Most metals and stones can also take quite a beating before they show any denting or other disrepair. Jewelry is also possible to resize, so you can just adjust it to fit any person. You'll always find people who try to sell cheap jewelry to make quick money, but you can usually tell which are fake. For example, faulty jewelry will usually have prongs that fall apart over time. Many of these fakes also contain materials like glass that will shatter when put under pressure. If you're not sure about the authenticity of jewelry, though, you can always visit a professional. Beauty and style. You can always tell the good jewelry from the bad by looking at how well it shines. Cheap jewelry looks cheap, and high-priced jewelry always appears to shine, and most people notice the difference. Expensive jewelry usually fits any style, while cheap jewelry looks boring. Expensive jewelry also looks good with others of its kind, while cheap jewelry just looks tacky when combined with other cheap jewelry. Most people get started with jewelry as a way to treat themselves, and since it never goes out of style, they can wear it for their lifetimes. Husbands and boyfriends are also key targets for jewelry companies as they like to buy them for girlfriends and wives. Expensive jewelry is easy to pick out because they know it'll look good on you no matter what your size. Prestige. Most people correlate expensive jewelry with high status, mostly because high-quality jewelry is highly expensive. If you're looking for a good investment, you'll likely not find good jewelry for less than $2,000. When people see you wearing expensive jewelry, they'll assume you're rich, even if your clothes are shabby. Of course, jewelry has been used as a symbol of prestige for years. Kings and queens use rings as signs of status, showing that the more jewelry they put on their fingers, the more power they had. Often, royalty would give jewelry as a symbol of their rise to power. Today, celebrities use this same principle, often sporting expensive jewelry to show that they've improved their status. Emergency funding. No one wants to pawn their jewelry, but jewelry can usually fetch a handsome price on the market if you need money immediately. Of course, you'll likely only see pawn shops that accept silver, gold, and precious stones. But if you've invested in expensive jewelry, that won't be a problem. In fact, you can also use jewelry as a form of barter on today's market, as gold is considered a form of currency in many countries. You'll get more out of diamonds that follow the 4 C's: cut, clarity, carat weight, and color, Davis and D. The more intricate the cut, the greater the clarity, the heavier the carat weight, and type of color all play a part in raising the price of diamonds. Higher-end pawn shops will almost always give you more money if your jewelry follows one of the above standards. How to invest in jewelry. Jewelry can pay your rent or make you rich if you make the right investments. However, how do you know that the jewelry you pick is going to be the one to stand the test of time? Like all other investments, there are certain rules that dictate whether a piece of jewelry will be as favorable as others. Below are some strategies to purchase jewelry that will inevitably make you rich. Brand and staying power. Like artwork, there are reasons why some artwork is more expensive than others, even if it's the same era or quality. The brand of your jewelry says a lot about its quality and history, which has a lot of appeal in wealthy circles. Your jewelry doesn't have to be flashy or encrusted with an array of jewels to be the most valuable jewel on the market. Coco Chanel is an excellent example of staying power. Though her original work was often used as simple trinkets, today that jewelry is worth a fortune, simply because it carries the name Chanel. Likewise, Cartier watches increases in price over time, and they never go out of style. According to a spokesperson from Cartier, no watch has ever sold at an auction for less than its original price. The Loop, 2015. Other brand names carry similar clout, and if you keep them in pristine condition, you'll likely fetch a handsome price in the future. Brands that carry clout also become more valuable over time. Imagine finding a Cartier watch that dated back in the late 1800s. Your watch would be priceless, and Cartier itself may be interested in buying the watch back and placing it on display. Of course, the brands with the greatest clout are those with signatures attached. Depending on the decade, older jewelry can become extremely valuable, even if it's not made of precious stones or metals. However, older jewelry that do still have original stones and metals can be reshaped or tuned into other jewelry and sold as vintage pieces. Adjust for inflation. Unfortunately, inflation eats into a lot of jewelry products. Though jewelry from the past may seem to have a high price tag, it doesn't likely have the same value as it did in the past. For example, the Cartier Love bracelet had a price tag of $250 in the 1950s and has a total price of $6,000 today. If you adjust for inflation, the price of staying power for the bracelet, buying a Cartier Love bracelet, would be worth approximately the same amount today as it was in 1970, the Loop 2015. Ultimately, you'll probably get more from buying one today. Invest in gold. Ron Swanson's declaration of changing all of his assets into gold has become a beacon for success today. Gold has skyrocketed in value, and it doesn't fluctuate much over time. With the increase of inflation, you're likely to see gold continue to rise significantly over time. However, gold is best invested in bulk. If you only have a small ring or some dust from panhandling, you're not likely to make a lot of money. The more you purchase in bulk, the greater your return later. Always watch the market when you do sell gold, however, as market prices can change. Though they always show a steady increase, the nature of the market makes it unpredictable. Invest in time. Just like artwork, jewelry often becomes more valuable over time, so you might have to hold on to jewelry for several years to see it appreciate in value. In some cases, jewelry can take half a century to appreciate to a significant level, so be prepared to stick with it for the long haul. The good news is that jewelry maintains its resale power if you need to sell it quickly. Conclusion. So many investment schemes fail because investors weren't properly prepared before getting into them. Today, it's easy to get caught up in new investments, and those that try to insert themselves into an industry they know nothing about often get burned. The only way to navigate through the sea of misinformation and disappointment is to have a clear plan and know what you're getting yourself into. Spending on yourself is the best way to get a leg up in this world and make investments that will impact your future for the good. Though it may seem like a burden to spend money on an investment, you'll almost always be happy that you made the choice to focus on yourself. This book will continue to help you make good investment strategies long past when you finish. You can use this book as a reference that will give you the proper information about how to invest in strategies that will ultimately lead you to success. Investors interested in real estate can make money by flipping homes, renting, or resale. Those interested in real estate investment usually are drawn to the vast income you can make from sales and renting with little effort. Properties appreciate over time, and you can use them as leverage for future purchases. Investing in real estate comes with tax benefits, and it's a great way to diversify your portfolio. The best ways to invest in real estate are to buy REITs, use online real estate investing, flip properties, rent out rooms, or invest in a home for yourself. If you're looking to invest in your future while at your standard job, look into the 401k and retirement programs. These retirement programs have tax advantages, and you're completely in control of your income. The more you put into your accounts, the more they'll appreciate with time. You can maximize your earnings by diversifying your account with multiple types of funds. Like real estate investment, you can make a lot of money investing in a small business, though you'll likely have to input a significant chunk of change to make that happen. Most people choose to start their own business because they like the idea of working for themselves and having control of their finances. You can improve your small business by setting goals and improving your sales skills. Find a marketing style that works for you and make money from doing the things you love. Small businesses also get tax benefits, so if you have the time, money to start, expertise in a market, and are open to risk, starting a small business is a great opportunity. If you're looking for precise measurements and time in the stock market, invest in stocks and trading. It's often more affordable than you think, and it's a great way to grow wealth, diversify investments, and outrun inflation. Always decide on how much you want to invest before you start looking. Set a budget and make an investing strategy work for you by never going past your boundaries. You can either get help from professionals or do the majority of it on your own, depending on your preferences. Finally, you can make significant money in physical investments as long as you're willing to play the time game. However, investing in art is not a guarantee, so you'll need to have an interest in acquiring art for your pleasure. If you love jewelry, you'll find that there's a huge market for the right kind of jewelry. Jewelry has durability, beauty, prestige, and is easy to sell in emergencies. When you're investing in designer jewelry, look for brand names and security. No matter your preference, there's always someone interested in your style of jewelry. Whatever your interest in starting an investment, there's always room for you to grow. Analyze your market and spend money on yourself. You'll often find that the money you put into your future comes back in tenfold. The end.